For everyone who's joining us on the call at the moment, thank you very much for your time and attention. Over the course of the hour, we're going to try and dig a little deeper into the results that Stanbic Holdings has provided for the full year, for the 12 months in 2024. There's a lot of interesting trends and data and specific data points that, of course, you can look at. Everything from NPLs, loan provisions, the decline in the size of the loan book, and so on and so forth. And we'll cover plenty of those in the course of the conversation. So who are we talking to today? Dennis Missel is the Chief Financial and Value Officer at Stanbic Bank. We've produced some fairly interesting results over the last 12 months in 2024, and we'll be diving a little deeper into the details of that. Dennis, I want to start with the one that I know has gotten a lot of questions, at least in my end of the world. Cost of funds questions, because your interest expenses went up by over 100% last year to 21 billion shillings, at least for the Kenya operation. But now we're seeing Treasury bill rates trending lower at the moment, implying that if you're going to compete for capital in the market, it should cost you a lot less. Should we expect the bank to have an easier time sourcing lower cost deposits in 2025?
Thanks, Rama. Thanks for the opportunity to dissect the numbers. And I'm glad we've got an audience to unpack some of these trends and statistics with. Do we expect the cost of funding to trend downwards? Maybe we answer that question as to why was it up anyway in the first place. And I think you've touched on it. When instruments yields, particularly government yields in the market, are high, depositors, especially those who look for yield, divest towards those instruments. The rates in 2024 and actually in part 2023 were of such significance that it didn't make a lot of sense to keep a lot of quote unquote idle cash, whether as an individual or as a business in a current account. So current accounts were generally anemic, most of them staying relatively dry, and people then put money into savings accounts and fixed deposit and a government instrument, depending on their appetite. With rates coming down, definitely we do expect, and we have started already seeing that on my monthly tracker of the interest expense coming down. It also does transmit onto the cost of lending. So you'd have seen banks announce some rate cuts, and that's partly because our pricing models are mostly cost plus models. So it's cost of funding plus a few other costs, and then you get to your pricing. So definitely we expect lower cost of funding. And yes, we also do expect lower gross income. And therefore, we may then end up having minimal, if any, change to the net interest margin.
And that sort of answers in part my next question, because that's where we're heading to next. The question around the outlook for net interest margins in 2025, because on one hand, as you've said, the cost of funds looks to decline, and then look at the demand side of the business, demand for credit, both short-term, long-term, and so on and so forth. It was very subdued last year. In fact, I believe at some point last year, towards the end, I think in Q3 or Q4, the credit growth actually turned negative. Should we expect this trend that we saw this year, that decline in net interest margin, will that continue this year, or should we expect a bit of stability?
I think the growth of private sector credits is part of the social contract that banks have with society. We collect deposits on one side. It is our responsibility as banks to avail that liquidity for real economic activity in the market through lending. So any banker out there is thinking, how do we drive private sector credit growth? The levels that we saw towards the end of last year at just below 1%. We last saw that in 2011 or 2012, at least more than 10 years ago. We were used to 13%, 14%. And if you think about it, you want your private sector credit growth to be above GDP so that you're driving expansion. So definitely all of us are thinking about how much do we need to do and to drive that. Part of that is thinking about cost of credit. Now, you've heard about bank rates and base rates, etc. But when I did some subtle survey last year, credits touched anything between 15% and more than 25%. And it's quite difficult to invest in a business where your returns are expected to be more than 25% and you haven't even paid yourself, you haven't paid salaries, etc. So that delayed a lot of investment decisions. And what we are hoping to see with rates coming down, T-bill rates have come down close to 600 basis points. I genuinely hope that we can see cost of credit coming down by similar, if not the same kind of margin, so that we can start sparring. That said, of course, and I'm sure the question of how we price credit will come up, so let me probably defy it to then. But we really just have to work out how to ensure that credit out there starts to pump again.
But even leaving the cost of credit aside for the moment, just looking at the wider macroeconomic picture, I'm not sure what data sets you might be able to see, but if you just look at the broader picture across the entire economy, if you use fuel, for example, as a proxy indicator, fuel consumption last year dipped by quite a bit. In fact, if you look at diesel consumption alone for 2023, 2024, it's fallen rather to levels that we didn't even see during the pandemic around 2020, 2021. So if we use indicators like that, or if you try and use proxies, the importation of borders, if you go back to the same timeline that you used a little earlier, 2014, 2013, and so on and so forth, we've been importing about 14,000 units every single month into this country. Last year, it was probably around 5,000, 6,000 units a month at best. So the indicators I see, the ones I look at, just suggest to me that there simply isn't any disposable income available in this economy at the moment. So even if, for the sake of argument, rates do come down, is private sector credit demand still there? Or should we expect another year when we look at Stanbic's books in 6 months, 9 months, 12 months time, and your loan book has contracted again?
If I go back during COVID time, I think 2020, 2021 is the last time our balance sheet stayed flat year on year. So in 2020, 2021, our balance sheet was 328 billion one year and 328 billion the next year, changed by a few hundreds of thousands. In 2022, our balance sheet grew by 22%. What happened? There was real pent-up demand for credit post-COVID. There was almost revenge investment, revenge spending, revenge holidays for people who had been held up by the COVID pandemic. What's the difference between then and now? There were actually tax incentives. We didn't see taxes increasing. If anything, I think there was actually rate decreases at the time. So there was real demand awaiting the episode to end and for spending to come through. It's not necessarily the same around this time because we're saying rates come down. Okay, that's one variable. But then there is the size of customer wallets, which of course drives spending. So am I expecting a 22% increase on the balance sheet in 2025? No. But am I expecting some growth? Yes. And I will also give a rider as to what could happen to not achieve that. But part of what I am saying is informed real and actual customer conversations that we have progressively, where customers are saying, we can't borrow now, I can't invest now. I normally do 3 containers in my trade. Because of the rates being high, I've now reduced that to 1 container. But if cost of credit starts to come down, I'm going to go back to 2 containers and put. So there is real, actual economic activity that backs this. The data points you share are real and true, but there are also data points that say tea exports, for example, have reached a significant high in the last year. So there are pockets of dim lights. There are also some other pockets of bright lights. What could cause this to become more problematic is, and it's twofold. So global policy, I do honestly hope that the stances that the US is taking do not start manufacturing new wave of inflation at a global level, which of course will come down to rates increasing. So I do hope some level of adult supervision goes on quickly and the countermeasures start to feed back to its policy and ease that. So that's actually my biggest fear. One of my bigger fears is whether we manufacture new wave of inflation quickly at a global level. And then locally, there's still quite a bit to be unraveled about government spending. You would have seen the BPS and the expected spending in 25-26. It's still not very clear where we are going on government borrowing and fixing the fiscal deficits. It's also not very clear where we're going with the IMF program. If any of that means more local borrowing and therefore rates start to turn upwards, inflation has started turning upward, but it's still not yet at a point that is alarming. But if rates start picking up, Rama, you know where it is going to go. So we're going to get quickly back up to where we were last year, which is really not what we want to see.
The other thing that I'm not sure if it falls into the same risk matrix for you as it does on our end of the pond would be tax policy, right? Because yes, you've covered where the BPS is in terms of government spending. And before you even get to the budget policy statement, if you just look at the supplementary budget that was submitted to Parliament at the moment, there's some really big increases in spending that the state is asking for in that document too. From where you stand, given what we saw last year, the proposal to essentially impose more taxes on individuals. And that triggered this massive decline. And we actually saw it in the PMI data that your economist and the guys at S&P put together. Huge decline in spending and inventory and so on and so forth. Is that still an existential threat, so to speak, to private sector credit growth going forward?
I think it is. I think what we have seen, political leadership after political leadership, there's an affinity, at least this part of the world, to lead fiscal consolidation through revenue measures. So the easiest attack vector has been raise more revenue, tax people more, etc. And the argument is not don't tax people, but it appears to me also that taxing is on a smaller and a smaller base now. If I say increase VAT, I'm sure a few people will log off this call because that's not popular. But is that what we need to broaden the tax base? I don't know. But I think there needs for some revenue-led fiscal consolidation. But we actually do need to see some expenditure rationalization on part of government. And again, it's one of those painful things to do and to lead with as a politician. But the reality is we are increasingly making it very difficult to sustain our level of expenditure, the size of our budget, and therefore that just is increasing the pressure on individual and corporate wallets. And that is actually evident in some of the macros then that we are seeing. The latest print of GDP growth, Q3 2024, showed that the last time we saw manufacturing expansion at where it is was during COVID, Q3 2020. Now, that's scary, guys, because if you look at our regional competitors, Uganda, Tanzania, their manufacturing, although it's still low, but the level of expansion seems to be ticking up quite quickly. The level of FDI that is going to Uganda particularly. Uganda, if you adjust their growth aspirations for some of these factors, what might come from the ECOP, which is closer to 50% concluded, Uganda very soon will be growing at double digits, 9, 10% or thereabout. So there's something about how we are planning our spending, how we are balancing revenue measures vis-a-vis expenditure, and even in the expenditure, how we are balancing the equation between recurring expenditure vis-a-vis expansionary or investment expenditure. That needs to be relooked. And then when people then are contracted, they need to be paid. And you will realize that there's a lot that happens when you just pay people, because Peter pays Tom, Tom pays Dennis, Dennis pays Rama, and there's money in the market.
Indeed. And that actually brings me to NPLs quite neatly, because looking at the annual changes in the size of the non-performing loans that you have on the books, the gross NPLs, those are down 14.4%. The net NPLs, those are down by 18%. But your loan loss provisions, those are down by 51%, down from 7.3 billion to around 3.5 billion shillings last year, which effectively covers around 20-something% of the bank's net non-performing loans. Walk us through the rationale here for your provisions, because as an outsider, if I just looked at those numbers, by implication, my reading of it would be management and the board reckons that the worst of this is probably behind them and they don't need to be provisioning as much capital because future risks are not as high as they were 2-3 years ago.
Yeah, looking at them, they could send the wrong signal. So let me unpack our NPL. So our NPL, when we closed last year, was 9.47. Last year in accountants' world, it's a year in arrears. So I'm talking 2023. And then we closed 2024 at 9.11% in NPL ratio. Our coverage ratio, which is the level of provisions that you're holding against your non-performing credits, in 2023 was 63%. End of 2024 was, in theory, our level of optimism hasn't quite changed, but neither have we increased our level of pessimism in terms of ability to recover. So what has happened? Why are the numbers year on year in terms of the P&L charge changing? 3 things. Number one is in 2023, included in that 6.2 billion charge number, some chunky names, particularly in our business and commercial clients segment of the business, that we took additional provisions. Those are those names that follow the cliff. And remember, 2023 is actually when rates started picking up. So we saw some of those names go under extreme stress between the Q2, particularly of 2023 and Q3. And therefore, we took a view to increase the provisions. So there is a base effect included in there. So that's the first factor. The second factor is if you come to 2024 and you look at the provisions, those provisions are currently adjusted. So we've got close to 700 million credit note purely because of the currency resetting. What does that exactly mean? So 45% of our non-performing loans are in foreign currency. Dollars, euros, and GBP here and there, but the main numbers are in USD. So the Kenya shillings appreciates against the USD because we are carrying the Kenya shillings equivalent of the provisions that we need. You basically then get a currency appreciation credit note out of that. So that's second. The third one is just the reduction in the loan book because your loan book has effectively contracted, and under IFRS 9, the accounting standard, you carry impairment on all your loans, including the one that you originated yesterday. There's a reduction in what we call general debt provision. So those three factors actually explain the year-on-year movement. But what's my comfort? Our coverage ratio remains pretty much where it was. And if anything, I'm seeing more traction in resolving the names.
With respect to NPLs, can we get into a bit more detail there? Are there any specific sectors in which they're concentrated, the factors that drove them to where they were? Some of them are now coming off, like you pointed out. The rate hiking cycle was partly a contributor to what happened. When people are essentially looking at borrowing rates of 20-something%, obviously that becomes significantly painful. Where they concentrated, have those risk factors that essentially drove them upwards, have they now tailed off?
So two particular sectors, I wouldn't actually say, other than for the ones that fell off in 2023, no new factors have come to impact those NPLs. A lot of that credit is actually 2016 to 2019 lending. And it's largely in project finance, manufacturers building or setting up new industries or new operations or extending their operations. And then something turns in the market and that which was a viable investment doesn't work out. So actually, when I look at the 22 billion, there's nearly 40% that is in that whole project finance area. There's another double-digit percentage that is in commodities, in agricultural commodities. So agriculture related, about 2 names there. We don't have a lot of names. Actually, if you look at that 22 billion, the top 6 or 7 names count for close to 80%. So it's largely agriculture sector and some project finance. Now that project finance is everywhere, from people trying to do manufacturing to some level of real estate. But no sector has been rendered particularly more vulnerable by the recent challenges. They only get trained because if you're already struggling and then rates go up, then you get into more trouble.
With respect to recoveries, because I think one way of looking at where your NPLs are concentrated right now is essentially it's a handful of firms. But I'm just trying to look at the bigger picture here with respect to the judicial system that we have in mind, because the case backlog there fell marginally in fiscal 2023, down around 2.2%, but it's still pretty high. 650,000 cases that are still pending somewhere in our legal system. So between that backlog and how slow our judicial processes are, how are you adjusting your recovery process as a bank?
You're right. Actually, the most painful way to resolve any customer relationship that goes sour is to try to take it through the courts for multiple reasons, for part of the statistics that you've spoken to, but also the technical legal arguments. You get stuck into pretty perfunctory legal jargon, which doesn't help the customer, it doesn't help the bank. So we try as much as possible to reach out of court arrangements that are both accommodative of our interests and the interests of customer. I would say there are 3 types of non-performing customer classes. The first is I started a genuine business. I thought I had a viable business. It doesn't work out or something doesn't just work out. Such customers are very amenable to wanting to sit around the table, agree how to resolve. Out of court is usually easier for them. So that's the first bunch. The second bunch is the customers who borrow and then something suddenly happens and it impacts either a market turns or they get into trouble with regulators, whatever happens. Again, that's another bunch that is easy because we can see the assumptions that they made don't hold where they can see it, and there's some genuineness in the engagement. There's a third bunch of customers who borrow with the intention of never repay, and those people are real and they exist and they're out there. And those are happy to dance around with a bank for 10 years, for 15 years, or whatever amount of time. And those are the ones where out-of-court settlement are difficult. And quite honestly, if you look at bank balance sheets, those are the ones that will stay the longest and keep the NPL ratios quite high. We try and avoid that through how we onboard, character verification, where we are engaging customers. But you'll always get one or two that give you that trouble.
I want to get back to the rates transmission question, because I know we covered it briefly in passing a little earlier. And the speed and efficiency of rate transmission decisions has always been a big concern, right, in this market. When the central bank raises rates, transmission happens relatively quickly. When cuts happen, the complaints that we often hear and see in the market, and the data backs us up, is the transmission of those cuts, or more often than not, tends to be relatively slow. And one of the interesting conversations at the release of the results yesterday was this ongoing talk around changing the architecture for risk-based pricing, including perhaps moving towards a secured overnight rate lending style arrangement. For some of the older listeners on this space, they'll remember about 10, 11 years ago, we had something called KBRR, the Kenya Bank Reference Rate. In fact, if you actually go to the central bank's website, you can probably still find some of that legacy data over there. And that was essentially an average of CBR and the 91-day T-bill rate. And the idea was that we'd essentially use that as sort of reference rate for pricing loans and so on and so forth. What would a new potential arrangement have to do in order to avoid the same pitfalls that KBRR?
Rama, this is a touchy one. I hope I don't get into trouble. We had KBRR between mid-2014 and I think September 2016. And you're right, it was a balance between the CBR. I think 50% was CBR and 50% was tracking the T-bill to just transmit a policy. Why did it not do too well? If you have a CBR that doesn't quite track the interbank, or doesn't, for whatever reason, either because of liquidity pressures, either because of FX impact, whatever reason, then it becomes very difficult, because you're trading with customers in one corridor and your engagement in the market, which is the most liquid and moves a lot of money, on another corridor. So it becomes very difficult. And then we had interest rate caps, which had their own negative challenges or negative impact, particularly exclusion of customers from the credit market, because as we've said before, there's a price for everyone. And therefore, if you cap the rates, then you naturally exclude some people. That was 2016 to 2019. Then from 2019 onwards, we are on some form of internal pricing stroke, the risk-based pricing that is approved by the regulator. A lot of those models, particularly our model, which I can authoritatively speak to, is a cost-plus model, which is a build-up of how we run the enterprise etc. Again, that has had its positive effect, but it's also been challenged in terms of its ability to face the market and transmit those. So effectively, the story there is every model has weaknesses. And what you can do is then learn from what you've seen in the model and try and adjust the sales for the next one. Where do I see an opportunity? If we were to get back to a reference point, is to get to a reference point that is uniform for pretty much all the banks. What's the difference between KBRR at the time and a uniform reference date today? I think today, given the fact that the Intrax, the CBR plus or minus 150 basis points, initially 250, but now 150, there's some form of predictability as to how the CBR is tracking, which was not there in the KBRR days. So hopefully that does help. But the other thing that needs to be considered is the idiosyncrasy of different banks. Of course, different banks are running different portfolios with different quality, different customer profiles, etc. So if we're able to balance first, how do we ensure that the base rate has some form of referencing to the market, especially now that there's a lot more predictability? And then two, allow a factor which compares or contrasts Bank A from Bank B based on the customer profile, based on investment in efficiency, etc. And then still maintain the principles around transparency. These prices have to be disclosed to the customers. Customers have to be able to choose between Bank A to Bank B based on transparent information and not something in dim light. I think that way we learn from the three phases of models we've gone through and play our part in driving credit transparency and availability in the market.
Might we end up in a situation where we have a sort of two-speed market? Granted, that's a slightly crude way of putting it, because if I look at where customer deposits are, where the concentration on the loan book, it's basically the top 8 banks in the country, right? So might we end up in a scenario here where it makes more sense to move with a sort of secured overnight finance rate approach to pricing loans for those tier ones, and then risk pricing models of various sorts over a specific time frame, 2 years, 3 years of adaptation for the remainder of the market?
I would not segment the market that way. I would, however, allow the customer in whatever bank they are in to make that choice, to say you can choose reference rate. Let's call it a reference rate. You can use a reference rate or allow the customer to make reference to a market rate or a T-bill it is. Today, as we speak, despite most banks, including ourselves again, having a risk-based pricing, our models still allow for when a customer asks to be priced off a market observable rate, 91 T-bill, 182 T-bill with specific reset date. That is allowed. And in fact, in some of our segments, especially for our corporate customers, 100% of our customers in the corporate banking area are on T-bill because they have treasuries as good, even if not better than the banks. They're watching the market. They're making decisions based on which currency they want to borrow in and why, whether there is an arbitrage between the currencies, and therefore they want a market to borrow in. So I wouldn't segment the market into big banks vis-a-vis other banks and have different reference rates. It would be have one reference rate, but allow the customer to choose between one reference rate or a market-facing reference rate.
I want to go back to the loan book, because I know the bank now has exposure as well to the G2G oil import arrangement. A big chunk of it obviously lies with your competitor. But in going back to the reference that I made a little earlier to the consumption patterns that we're seeing in the market for diesel, petrol, for kerosene, and so on and so forth, we've seen actual imported volumes being under the contracted amounts. And the IMF, in fact, pointed out this in November last year. What contingent risks are you concerned about, if any, with your exposure to the G2G arrangement?
The size of the market is an extraneous fact which we pay attention to, but our job is actually to try and bake more cake as opposed to assuming the cake is finite. So the view on the way we think about this in the bank is, okay, there is G2G, but that's not all the trade that there is. There is expanding trade in agriculture. There is expanding trade in manufacturing and other sectors. Particularly, there is expanding trade between East African countries, save for the intermittent challenges we have with regional conflicts. More and more of players in this market are interacting and selling in the market. So actually the strategic question that we ask ourselves in the bank is to say, how much trade are we doing outside of G2G? Because that's just one vector. And then in addition to that, because the oil sector is still very material, how much do we need to gain? So to answer your question directly, diversification of how we think about trade amongst or alongside very many other vectors of our business, which continue to.
Just to go into a bit more detail on that, because how exactly does this work? Because I'm trying to figure out if there's any exposure, any risks essentially that the bank is running in this process. Because essentially it's accumulation of shillings, some of which gets recycled into treasury bills with a view to settlement. I believe it's over 90 or 120 days of payment. And the number that we saw from the presentation was at about 100 million plus. Is that growing? Is there any risk arising from the fact that you have this cash sitting essentially on the books and it has to essentially get recycled into US dollars for settlement at some point in the future, probably 3 or 4 months down the line?
Rama, clarify the 100 million?
I'm trying to remember where that was from, because it should have been from the presentation that was done yesterday when the results were being released. Let me try and see if I can find it.
So I don't remember that number particularly, but I get the gist of your question to say you've got quite a bit of your balance sheet that accumulates and unwinds over a period of time. I think it's 180 days, goes back. That arrangement for us and actually for the competition. If I answer that question with another question is to say, why would banks that are participating in the OTS arrangement still be facing liquidity pressures? So why would banks that are dominant in this area, and there's quite a number of them, still be showing significant increases in interest expense? The answer can only be that the liquidity coming out of that area or out of that business is ring-fenced to certain investments, which is what you alluded to in T-bill. So it's ring-fenced in terms of how you manage that particular balance sheet. It comes in, you pack it in a certain way, you manage your current risk, your margin risk, and at the end of it, you unwind the LC and serve the market. That doesn't impact your ability to continue serving your customers in agriculture, in manufacturing, and in the East Africa corridor, because you still have your other liability raising mechanisms to serve on and off balance sheet demand the rest of the trade. I do hope that's where you're angling.
Yeah, pretty much. And actually, you just found the relevant number in the slide, because what you said was, I think this was a section actually just before your presentation. Energy sector support oil importation, $170 million loan exposure. So that's the number I had in mind.
I see.
Because G2G, given the opacity that we have around the nature of the contracts, how is it settled, who's bearing the currency risk? As an investor, there's always a question around, the state is not exactly saying how this works in detail, because we can't see the documents and make the judgment ourselves. Therefore, when we hear that banks have gotten into this space, we're like, okay, so what's your exposure? How are you managing this risk?
It's quite ring-fenced. And so the biggest, if you're asking this question from a commercial arrangement and from a risk management perspective, so two quick points. One, from a commercial arrangement, the economics are pretty much known, except for very few variables, especially the currency. Now, with the currency having stabilized, that becomes muted. So that's one aspect. From a risk management perspective, liquidity risk, ability to meet the liquidity demand at the maturity date, impact on liquidity ratios and liquidity profile, especially for banks with a bigger balance sheet war chest, because the cycles are short. It's not that material because you ring fence it, you pack it in certain instruments, and you manage it through the cycle. Unfortunately, I can't share the specific numbers, but that's how it works.
Agriculture, 9% of the loan book is in the agriculture space. And we've seen some interesting developments in that space, especially over the last year. Coffee prices hitting record highs, smashing records over last at in the 70s. Tea export volumes up 20% in the first 10 months of the year. What's the outlook you have at the moment for those two commodities based on the conversations you're having with clients there? And how will that then translate into what we see in interest income and NPLs?
That's one of our areas of fortune. And it just follows because Stanbic has been here for many years and has been a leader in industries or sectors that drive the country's growth. Now, agriculture is 22, 23, 24% contributor to our GDP, particularly because of what it does to the masses in tea, in coffee, and all those areas. So it's an area that we are deeply entrenched in. I don't have the latest statistic now, but more than 80% the last time I checked of the tea trading that happens at the auction in Mombasa goes through a Stanbic platform. And we're expanding our canvas of services to those customers. So do we expect an uplift out of this? Absolutely. Are we looking forward to it? Absolutely. Are we having conversations with clients to ensure that we continue driving that growth? Absolutely. Do we want to continue doing that business? It's inevitable because that's where the biggest part of the economy is being driven, either directly or indirectly. Does that reduce our appetite for the other? Not necessarily, but yes, we do expect to continue growing in agriculture and doing a lot more. I've just mentioned tea, but we do quite a bit of coffee. We are getting into local societies and supporting them with last mile credit. So there's a lot more that we are doing there and would like to continue doing.
Just out of interest, how sensitive are these revenues from those two commodities, coffee and tea, from the data that you see to climatic effects? We go through this crazy drought, for example, like what we had in 2022, worst drought in 40 years. Crop production gets absolutely savaged across the board. And it does seem now that those cycles between tons and tons of rain and having a really sharp drought, those cycles are getting much, much shorter, much more compressed. By extension, doesn't that make the yields you get from clients in that space also relatively volatile?
Those sectors are particularly impacted by three factors. One is the one you've mentioned. Climatic conditions, changes, etc. does have an impact. Usually it neutralizes. So when there's drought, supply goes down and there's a compensation from the price movement and the reverse happens. So that kind of flattens to the cycle. The second is the exchange rate, actually, which impacts the earnings that are coming to the player in those sectors. And the third one, believe you me, which has a massive impact, is dollar availability. So in 2023, when Egypt and Pakistan, those are big consumers of the tea from Kenya, who are going through a dollar liquidity challenge, we could see the impact on the earnings from those customers. But I guess, Rama, the big question or the big comment and what I've learned in this banking area is that you really have to be able to stay the course with those customers, because nothing has changed in the fundamental of a coffee exporter or tea exporter when Pakistan doesn't have dollars or doesn't have access to dollars. So it's how you manage the relationship. It's how you help the client through the cycles. And I'm glad that there's none actually of our customers in those areas that has given us lots of trouble. So seasonal, but manageable.
Going into detail on that, the dollar shortages problems that you mentioned with respect to Egypt and Pakistan, we covered it, speaking from my perspective on the news desk at CGTN, and it was a whole other story. It was intense for companies operating in Egypt and in Pakistan. I wonder, because if I'm a tea farmer, like the SACCOs, for example, that you say you're dealing with, I've sold my tea at auction in Mombasa, I'm expecting payment, and Egypt and Pakistan are among the top 5 buyers of our commodity. And they turn around and say, hey guys, we don't exactly have the dollars that we need right now. How do you manage that FX risk? Do you take on it as a bank? How do you manage it?
That's where the business secret is, Rama. You're asking too much. But we study these cycles for long periods. And in our business cash flow modeling, we do stress some of those factors and test the limits of those stresses on the customers. And yes, some of them you cannot predict, because we didn't see the squeeze on liquidity availability in some of those markets as much as we did. But it's really what I've learned, Rama, it's the long-term relationship that you have with those customers, your ability to accommodate them within reason. Who sits with the FX risk? Definitely the customer sits with FX risk to the extent that it is an open exposure with them. How do you ensure that does not hurt them? Are you the one exchanging the dollars for them? Or are you in a position to provide replay? So to the extent that, for example, we've got left-hand flows from any other of our sources, while from remittances, etc. How do we help such customers to see the opportunity to translate some of their exposures into Kenya shillings, potentially unwind some of those exposures through other sources of cash flow? So it's the whole dynamic of how you manage a client relationship as opposed to the episodic challenges that they may be going through, because you've been banking these people for 30 plus years.
I've got one last question for you with respect to South Sudan. My sense is that as a bank, you're fairly optimistic about the resumption of oil exports from Africa's youngest country this year, despite the conflict and the volatility we're seeing with Sudan's civil war in South Sudan's neighbor to the north. Walk us through the base case that informs this optimism that we're seeing from Stanbic.
If you understand the architecture of the oil exportation in South Sudan, it all goes through the Port Sudan up in the north. There are 2 major pipelines, one that comes from the northeast of the country in South Sudan, and one that comes from the center, the north center, if ever there was a geographical description like that. One transports 30%, the other one transports 70% of the oil. Now, why was the force majeure declared back in 2023, late 2023 or early 2024? Because there was a big rupture on the pipeline, the subline that transmits the 70%, and therefore it had a significant impact. More than 95% of the national revenues in South Sudan come from this sector. So it was an existential risk, not only for banks operating there, but also even for the country. Where is our optimism coming from? That rupture has since been repaired. The force majeure has been lifted by the government of Sudan. There has been some agreement between the RSF and then the government, and oil is actually being produced now in South Sudan. And we do expect the first shipment, and we are in direct conversations with our clients who are actively involved in this business. We are expecting the first shipment in April, after, of course, the pipeline has been cleaned and gone through all the rituals. So that is where our optimism comes from a baseless perspective. There's always a bear case to say that the conflict in Sudan has not yet been resolved. And if that escalates again, it could be the Achilles heel to getting this optimistic stand going.
It's been an interesting conversation, Dennis. don't think I can thank you enough for taking time out of your schedule to have this conversation, not just with us, but also to all the people who've been listening quite patiently for the last hour or thereabouts. We're going to bring this space to a close at the moment. We've been speaking to Dennis Musau, Chief Financial and Value Officer at Stanbic Bank, going through some of the key issues in the results for the calendar year 2024, and of course the wider macroeconomic issues that essentially inform the numbers that we saw from that particular bank. The market certainly seems to like the results that came out yesterday. The shares closed up by around 6+% higher. They also were fairly positive just before I came online for this space. So hopefully it seems like the market actually likes the numbers that we saw coming out from Stanbic, and over the long run, we'll see what the market's judgment does look like. Dennis, asante sana for your time. And of course, to all of you who've been here very patiently with us for the last hour, thank you very much. Keep it for more content from Mongo Capital.